Hello, everyone, and welcome to the True Potential Do More with Your Money podcast. This is episode 62, and you might be able to tell from the pictures here that there's a bit of sunshine coming through at least three of the windows outside. We're recording this on Wednesday evening. It will be edited, depending on what Chris has to say this week, edited and then put out broadcast to tomorrow morning onwards. So welcome, everybody. You join us as True Potential completes a record quarter. Quarter one of 2021 has been fantastic by the way of business results, with more new clients joining us than ever before. So a welcome to regular viewers and a welcome to new viewers. Joining me today, I have on this investment management team special, Jeff Casson, Chief Investment Officer, George Bell, who is one of our investment analysts, a very important investment analyst, I will add, George, and Chris Leyland, Director of Investment Strategy for True Potential Portfolios. So we're going to touch on one or two subjects today. We're going to look back over the week, over the month, the quarter, and the year. But we, across the UK, we're enjoying unseasonal warm weather. Restrictions are lifting soon, and we'll be able to go to the pub and to the shops. Great news, eh? George, my local is called the Syntax, and it's named after a thoroughbred horse, which was running in the north of England in the 1814 to 1823, and it was named after, well, the horse was named after a William Combe character in comic poems. Just wondering, what's your local, George?
You made the Syntax sound very posh there, Mark, but my local is a pub called The Angel, which is in the Tyne Valley, which has got a nice seating area out the front, which I'm looking forward to sitting out soon in the sunshine with a nice cold beer.
Very good. Jeff, what's your local called?
Yeah, we've got a small restaurant just down at the end of the road here called the Caddyman. So as soon as things reopen there, we can get a beer outside, which will be quite nice. I'm just going to be a few weeks behind all of you lucky people south of the border, where things are easing slightly faster than they are up here.
And Chris, what's your local?
Mark, I think you know what my local's called. It's called a doghouse. So I often spend weekends in the doghouse.
There's a rumor going around the team, Chris, that you've got an ICE text, you know, in case of emergency, and it reads, Moira, I'm just going to have one more pint with the lads. If I'm not home in 20 minutes, read this message again.
I just keep on sending it.
Well, it's been a short week, as I mentioned. We're recording this on Wednesday evening, so we've got 3 days of market update. Jeff, if I can ask you to lead off, please. You know, just some of it will be a repeat of the morning markets update that you put out every morning. But tell us what's happened in the 3 days of this week, please.
Yeah, I suppose it's been an eventful 3 days, as it always is in markets, and I think that's why we all love the job that we do, and between looking after client assets, ensuring they're well positioned for it. But just the news that we have to deal with on a daily basis it's really been quite interesting this week, both in terms of broader market themes, what's been there in terms of a hedge fund in the US going radically wrong. I was actually looking at the name of it. We've been struggling as a team to pronounce it. I'm not sure any of us still know how to pronounce it, but I did Google the name and I had to look up as to what Archegos, or Archegos means. And actually, it's quite fascinating. It means to rule or to lead in Greek. Now, hopefully it's not leading us to anything at all, and it's a minor non-event, but a very interesting name for a hedge fund that's managed to cause some 10 billion losses for some of the largest banks across the globe. So that was something that started to come out into markets on Friday, and then feed into sort of some of the market performance on Monday, particularly for those banks really that are materially impacted. So we can think there of the likes of a Credit Suisse and Nomura, who do appear to have a lot more exposure than other banks there. The other things that we looking at and discussing as a team is just the ongoing move that we see with value relative to growth. And that's something that's been, again, just continued to be evidence over the course of this week, with value continuing to outperform. So up about 1.9% over the week versus for growth down about 0.6%. So that jaws continuing to open up between value and growth, as we've seen over the course of the quarter, and indeed over the course of the past number of months since November. And then just on underlying data that we've been seeing, really good consumer confidence numbers coming through from the US. Real significant improvement there. Employment prospects improving, being a key driver of that. We'll get an indication tomorrow on that when we get the initial claims report. But similar things in Europe as well, coming through with a bit of confidence in the underlying consumer there. But again, when was that taken? Was it taken just before lockdowns were reintroduced in large parts of Europe? So a mixed bag of data points, US and Europe. And then over to Asia, improving trends there with South Korean numbers today, which tied into global economy, global manufacturing, really good industrial production numbers coming through there. And that's supporting a good performance within the market over the course of the week. We've got global equities up about 1% over the course of the week. And the one thing that we have been touching on for a number of weeks is really what's been happening in the bond market. We're still getting, and we still see that level of elevated volatility within sovereign bonds in particular. That's been no different this week. We saw the US 10-year move out to a 1-year or even a 13-month high just earlier in the week. And that's playing its way through in asset performance, again, speaking to why value and some of the value sectors are performing better because of just that movement out in sovereign bond yields.
There's no shortage in appetite, though, Jeff, is there, for buying bonds? I mean, we see auctions in the US almost on a weekly basis now.
Yeah, and I think that's one of the key things that I think helped give some stability into the US Treasury market last week, where we saw close to 187 billion of three separate auctions over the course of the week, Tuesday, Wednesday and Thursday, and each of them being pretty well demanded. So if we think about what does that demand look like, well, it's people going in to bid for those, and they offer their bids relative to the most recent closing price for that bond prior to the auction. And we saw very little movement away from that initial yield to the yield where that bond was sold, which, cast our mind back 3-4 weeks ago, that was one of the areas when we had a very poor auction that really triggered this ratchet higher in sovereign yields. So there certainly is demand out there. There's a lot of liquidity still in the system, and that's a function of, I suppose, a number of factors that we've discussed. One, the support that central banks have placed into the market, but also just that fiscal stimulus. People have saved it. We know savings rates are high in the UK, the US and Europe. So there's an added impetus to that to an extent in the US with the additional $1,400 stimulus support checks that are coming out. So that liquidity has to find a home, and it's finding a home in various different places. But one of those is certainly there does appear to be demand for sovereign treasuries.
Yeah, and one of the big events this week has been the blockage of the Suez Canal. And if there's ever evidence needed that global trade is returning to normal and indeed record levels, it's just what happens when an important corridor like that gets blocked. You know, you talk about 450 ships waiting to get through. And, 9.6 billion of trade stuck there. I saw a figure there. It says that 9.6 billion equates to 6.7 million pounds for every minute that the Suez Canal has been blocked. So it's fantastic.
It's an amazing piece of engineering, I suppose, in its first instance, but then just the crucial importance to global trade. When you see the size of one of those container ships sitting in that canal, 30% of the world's container volume passes through there, bringing us goods from Asia and vice versa, taking things to Asia. But also, if we think about that, to your point there, and its importance to global trade, 12% of global trade volume goes through that canal. Crucially important to the flow of goods and services. And it's great that we've got it moving again. because the more it was blocked up, there was issues. Some ships were diverting around the south of Africa. That again adds 3 weeks to their voyage and material cost to it. And it ties back to one of those things that we've been thinking about as a group, and one of those things that's feeding into how the markets are at the moment about inflation. Delays cause issues for the supply chains. We know supply chains are disrupted. There's less goods available, and that is feeding its way into inflation expectations. One of the reasons bond yields have been moving up, but also just we're seeing it in some of the consumer data. We probably see it ourselves at times in certain items in the shop, with some foodstuffs, etc. So those are all they're real and they're visible to us. And as we've discussed, we've seen inflation expectations pick up, but then inflation numbers, if we look at Germany as well, that's picked up to, I think, 1.9% was the number that came out earlier in the week. So inflation is there, but it's still muted. But these are factors that could challenge that as we look forward.
Well, that's right, and supply and demand kicks in with vessel rentals up 47% during the days that it's been blocked. They'll come back down, but it could be that something like that feeds into inflation. Most likely be absorbed rather than passed on. But it just shows when things come to a standstill for whatever reason, the knock-on effects are tremendous.
Interesting. The other side of it is, one aspect of it is, of course, delays and the impact in which it has on supply chains. When I was at university, the textbook sort of terminology was around just-in-time production, which is all about getting materials to the factory gates just as you're about to assemble the parts or to manufacture the goods and products. What you're starting to hear about now is just in case, and this was one of the things which Maersk were talking about, which is one of the biggest shipping firms out there in terms of rethinking supply chains. COVID was one of those examples where it takes an event like that for companies to stop and rethink supply chains, how they can make them more robust, how they can make them more efficient. I think what we are starting to see is inventory building. So we are starting to see increased demand levels come through, as you say there, Mark. PMI numbers were a good example of that, where you are seeing slightly higher input costs because that demand is there to rebuild the inventory levels up. What's driving that? One side, you have got the fact that activity levels are expected to come through faster than potentially initially expected in many places. If we think about the US as an example, there you had the 100 million vaccination program in 100 days. We're moving rapidly ahead of that, and we're now talking about the 90-90 day, which is all about getting 90% of the adult population vaccinated by April 19th and have everybody within 5 minutes, or 90% of the people within 5 minutes of a vaccination centre. So you've got those two sides. You've got, okay, what does this actually mean today in terms of supply disruption, but how do companies think about this going forward, and how do they plan to make supply chains more efficient?
Yeah, George, and if you think of just Ever Given there's 18,300 containers on that vessel. There will be some supply chain disruption, but hopefully there'll be inventory at the other end as well that it'll come off the shelves and perhaps fill a short-term gap. That leads us on to March, George. We're almost through it. There's a couple of hours left to go. How have the markets performed in March, and looking at the first quarter of 2021 as well?
Yeah, sure. I mean, it's been a good month for the portfolios, to put that there front and center. If we think about the portfolios, balanced is up around 2.2% when you deduct the fund charges in there as well. The aggressive portfolio is up nearly 4%. I think just supporting those factors is really been the performance of the regions and the assets which are more sensitive to the economic environment. So on a regional basis, best performing are places such as Europe or Japan. On a sector basis, it's areas such as the industrials or financials where you started to see some strength coming through there. Value as a style is something which we do talk about in terms of our communications, more closely with advisors, but we do talk about it on the podcast events as well. That really captures those assets which are not really reflecting their true or their intrinsic value. So where there's perceived opportunity in terms of those assets. So you started to see that value recovery pull through, which has been beneficial for a number of our managers. Within bond markets, sovereign bonds have been a little bit of a headwind, but calmer environment to what we had back in February. As Jeff mentioned, the appetite for bonds has been a bit more acceptance recognised through the auctions which we saw earlier this month. Didn't see the same levels of indigestion as what we did back in February. Within corporate bonds, traditionally it's been more the lower grade credit which has been rewarded. So investors have been rewarded for taking slightly more investment risk within the corporate bond market. What's been beneficial for true potentials managers within the bond market is their ability to step outside of the traditional areas. So looking at areas such as Asian high yield, which has been more beneficial for them. Alternatives have performed their role very well. Remember, we are multi-asset managers. We're not just looking at equities and bonds. We've got alternative products in there as well. So they're not just providing that defensive nature, but many of them are providing strong positive returns. Examples of what they're doing, well, they've got the ability to express strong directional views, be that on sovereign bonds in particular, or exploiting the volatility which you're seeing in commodity markets or FX markets, or even capturing some of the increased activity which you're seeing in terms of mergers and acquisitions. So there's a number of factors which are really driving the returns of the portfolios, and it's a lot of that is down to the recovery in economies which we are seeing or anticipating as the vaccine programs roll out, as central banks reinforce their support going forward, and we start to see signs of additional fiscal packages come through as well.
I know that in the past, George, the traditional investment would say when bond markets are not so good, the equity markets are strong. The other way around, when equity markets are weak, bond markets are strong. But that hasn't applied so far this year. Just for everybody, and feel free, Chris, Jeff, to jump in as well. What is it that's driving the link between the bond markets and the equity markets at the moment?
I think in the bond markets, a lot of it is to do with inflation expectations and where they want yields to be. We're in a period of historically low interest rate levels, which are set by central banks. What the market is doing is taking a step forward and thinking about the economic recovery and what that will mean for price levels, be it input prices, be it costs, be it wages, and where they think inflation levels are going to get to. And with inflation levels expectations creeping up, where they think the corresponding interest rate should be to ensure that you have a sustainable level of growth or inflation within the market. What the central bankers are doing is having a challenge to manage those expectations. So a lot of the focus of our morning markets updates has been around central bank guidance. A lot of our calls have been around central bank guidance and where they are expecting to look to increase interest rates. If we take the Federal Reserve as an example, they've been very clear in terms of where they anticipate rates to start to increase. Dot plots is one of those. We use it in our weekly roundup charts, just to give an example of where they think we'll start to see interest rates hike. And you're looking out to, say, 2023, 2024, whereas the market is anticipating rates to come through much faster than that. So that's one of the factors which has been driving the bond markets relative to the equity markets.
You also see that coming through then at the equity market at a sectoral level. So if we think about the sectors that have been doing well, so the industry groups, it's those that are more exposed to that reopening of economies or to an acceleration in economic activity. So as George was mentioning there, the industrials, the materials area of the market, even energy, as we've seen, the oil prices recovered well, but energy in itself as a sector has been a good performer over the period. And then again, that just feeds to improving expectations of the economic environment. We think about where we're seeing in the US, there's an expectation of 6.5% GDP growth this year. And that, to George's point, is, I suppose, this where we've got the market trying to test the Federal Reserve or any central bank for that matter as to what level of inflation they're willing to tolerate with that level of growth. Because historically, one would have thought that we would have, and you would associate higher economic growth with a higher inflation level. Now, the question there for market participants to think about at the moment is, are there some of those big picture factors that we've discussed around demographics, high levels of savings, are they ultimately deflationary as well? So you've got this push and pull at the moment from rates at really low levels and inflation at really low levels. and the two things working together with a market willing to test. And I think Christine Lagarde might have said this morning something that the market can try and test the ECB as if throwing down a gauntlet to them, because they know they can put effort on it, but central banks can still step in because they can effectively print money and try and cap where yields move to. So it's a fascinating period for markets, and that interaction between the bond market and the equity market is really been really brought to life, I would say, over the past 8 weeks, as we've seen this movement up in sovereign bond yields, which is, caught a lot of people by surprise. A lot of people weren't thinking that yields would go anywhere, but the market's got a will to test both the participants and the central banks.
And Jeff, if you were a betting man, who do you think would win, Christine Lagarde or the markets?
I think the market can push, but she's got an unlimited checkbook that she can continue to use. So from there, I think the market will test, but she's got the ability to step in and try and defeat the market. But time will tell whether the market will push. It's a pertinent thing for the US as much, I think, as well, for who's going to test powers, where do they want to go with that. So it'd be a fascinating time to be sat in the cash room at the Treasury or at the ECB or down in the Bank of England, just thinking, well, what is our tolerance here? When do we think we have to step in? Because at the end of the day, we're trying to make a forecast, or they are trying to make a forecast, and trying to make a point estimate forecast of where inflation is going to be in 12 months' time is a pretty difficult task. So we'll see where we get to, but forecasting that, I don't envy their task.
And Chris, we'll bring you in at this stage. A lot of traditional portfolios have got set asset allocation. And what I mean by that, you might in the balanced portfolio be mandated that you have to have, say, 60% in equities, 40% in bonds. Now, we don't believe that type of rigid asset allocation is right for forward positioning portfolios. How are you positioning the portfolios now on those two asset classes, but also touching on something which you said earlier, which is the sector rotation in equity markets?
Yeah, absolutely. And, I think it's a really good question. The reason why it's a really good question is because it's something that we're discussing internally ourselves. And, a lot of people talk about that kind of traditional 60-40 portfolio. So exactly as you just said, 60% equities, 40% bonds. And if you look back, actually, in general, that's not necessarily been a bad place to be. But one of the reasons for that is because you've seen bond yields, except for what we've seen so far this year, you've seen bond yields just generally fall further and further downwards, and in certain regions actually move negative overall. So I think for me, you said the words there, Mark, which are really like looking forward. And I think that's really the most important thing. And, that's how we manage money. We manage money to look forward, to try and offer what we believe is the best risk-adjusted return possible. And I think, when we look at that, I think the reality is that you've got to in some ways think outside the box. You need traditional assets in there. You want equities in there as one of your key drivers of returns. You need bonds in there for diversification as well. We were talking a little bit around how there's still demand within bond auctions overall from investors, and certainly from us as fund managers, there is still demand to hold bonds overall. There's still belief in bonds, the bond role within multi-asset portfolios. But I think as well as that, you can look towards alternative assets. And I think that's exactly what we do within the True Potential portfolio proposition. So whether that be what I would describe as sort of traditional alternatives, so things such as, say, precious metals, for example, or whether that be, I guess, more esoteric alternatives, maybe esoteric's the wrong word, but I'd say more non-traditional alternatives. things like relative value plays, things like plays on volatility. If I think back to sort of February, March time, 2020, one of the best components of the True Potential portfolio, so one of the best underlying components, was a volatility fund. And what that did is that made money when volatility spiked up. And that's exactly what you saw during that time period. So for me, it's all about sort of taking it back to what are the key drivers of risk and return, and trying to think about that moving forward around, how else can we find sources of return while still holding equities, while still holding bonds, but trying to think of other asset classes that could do well moving forward. And I think, finally for me, I think we're actually in a really good position to do that. I think we've got genuinely some of the most innovative fund managers out there. We work with some of the largest fund houses out there, Goldman Sachs, Allianz, UBS, just to name a few. And between them, the amount of resource and knowledge that they have means that they're right at the forefront of product development overall. So for me, very, very pleased with having that option, having the ability to look outside of equities and bonds, but also having an understanding that you still want equities and bonds within that multi-asset construct overall.
I'll take you back 2 minutes, Chris, because you mentioned something before there, relative value, and it was in the middle of a sentence. We understand what you mean, but it's worth just spending a couple of minutes for our viewers to explain how relative value sits within the portfolios and the job it does for us.
Yeah, absolutely. So basically, relative value is taking a position between two different asset classes. And what you're doing there is you're going long one of the asset classes, i.e. you're just buying that asset class in a traditional way, and you're going short another asset class. So that means that you are borrowing that asset and then you're taking a bet that that asset will go down. So what you're trying to do is you're trying to exploit the relative value between those two assets overall. So again, it's just a sort of different way of thinking about return. If I think about how it's used within the portfolios, probably one of the managers that use it the most is Allianz. So they've got positions around sovereign bonds in there. So for example, say they've are long.
You could take it on a steepener position as an example, Chris. You could have one which is going long a longer dated bond and shorter dated bond, and from that you're pairing up the benefit of inflation expectations coming through. Or whether you could look at individual regions within Europe, within the bond market, you could play off those opportunities there. That innovation's still coming through. I'm in regular contact with Allianz, and I've just been on a very interesting call where you're still seeing that innovation come through. I won't share all of the ideas here because they are live, but it's great to see that even in an environment where you are seeing, okay, a bit of a calmer bond market this month compared to last month, where do we go from here? Well, we've got experts and specialists within the funds and portfolios who are finding opportunities, not only in a single asset, but by pairing the assets up relative to one another.
I think the beauty, sorry, I was just going to say, Mark, go ahead, you do your bit as just a follow up.
I was just going to summarize, Jeff, by saying that the relative value, it's based on research. So the investment manager is looking for an area that they do like and they're buying into it, but they've also identified areas that they don't like. So they're selling that, and the clients that we have in the portfolios, they benefit from that increased return on both the buy side and the selling side. So it adds to the portfolio performance.
Yeah, it's capturing that opportunity that they see, and it's a mispricing between two different assets that they compare together. I think the other thing that is worth drawing out, and it's coming out from everything that Chris and George is saying, is really the importance of active management within that, and the role of active management in identifying those opportunities. So, for example, building out that view on relative value, that's not something that one would see in a passively replicating portfolio. It wouldn't be looking to seek that opportunity, but there is the value of active management in trying to identify opportunities, to take advantage of those and enhance the return that's able to be earned when one might argue that returns are challenged within, say, sovereign bonds. But a relative value trade gives you the opportunity to really enhance that return profile by exploiting both sides of it, as George is saying and as Chris is saying.
Yeah. Gents, I know that we've spoken about this in the past, but perhaps for the last time on a podcast, I'm going to take you back a year. And 23rd of March 2020 was a time, I know that all of us were together in a room in head office, and we were doing a webinar to advisors and clients, just trying to make a bit of sense of what was going on. Chris, in the 12 months that have happened since that COVID-led market low, you've been steering the True Potential portfolios through what were pretty sudden and dramatic falls, but also a steady recovery, you know, through the lock-in months, through the vaccination months. And when I was thinking about this question, I actually asked myself, is recovery the right way to describe it? Because in the period since then, we've seen markets in the US and in Europe hit record highs. So recovery suggests that you've got back to a level that you were previously, but markets have pushed on beyond that. You know, what have been the key drivers of return in the markets, Chris?
Yeah, sure. I mean, maybe if I just start with the numbers and just to give you an idea of what we've seen. And what I'll do is I'll use that date of the 23rd of March and then just show you how markets have moved upwards. So the dates that I'm looking at, 23rd of March 2020 to the 29th of March 2021. So if we just look at the True Potential portfolios, so our lowest risk profile, which is defensive, a client would have experienced an 11% uplift. If we look at cautious, a client would have experienced anything between 21% up to 30%, depending on which portfolio they were in. If we look at balanced, those figures are between 30% up to 34%. If we look at growth, those figures are 35 to 37%. And if we look at aggressive, a client would have experienced around about a 43% uplift since March the 23rd, which to me is pretty incredible uplift overall. But I thought what might be quite interesting is just in some ways to take a step back in time and just think about what did we see before March the 23rd. And you know, if we look at what we saw within equity markets, so if you look at that kind of peak to trough drawdown, so basically from February the 21st, 2020 to March the 23rd, 2020, you saw global stock markets off around about 33%. Now, what I'm very pleased to say is actually the portfolios lost a lot less than that. So if we look at, say, our balanced portfolio, that was down around about 20% over that time period. So you can see it did offer a lower sort of drawdown experience, if you'd like to call it that, compared to global equities. But I guess, you know, just sticking with that incredible uplift that we've seen, you know, what are the things that I take away from it? I think, firstly, it shows just how important it is to stay invested. You know, one of the key things that I think all of us have talked about on the podcasts around staying invested. You know, investors clearly have been rewarded for not panicking at that time when we saw stock markets falling, when COVID was coming through. You know, that final day, the 23rd of March, coincidentally is actually the day when the UK went into lockdown. But investors have been rewarded for not panicking. You know, we have this phrase, and again, I'm sure, you know, we've all used this ourselves, but time in the market, not timing the market. And what that means is don't try and be clever. Don't try and sell out when you think you're right at the top of the market. Don't try and sell out if you're panicking around something, because most of the time people get it wrong. And for me, that what you've just seen is the perfect example of that. And then I think just finally, you know, why have you seen such a strong recovery? I think there's various different reasons there. I think firstly, you've seen central bank and government action. You know, that horrible word that we use all the time, unprecedented. we used it so many times, but it's fair. We've never seen such an amount of money being spent on support. So support for individuals, for companies during the COVID, support for economies overall, and that's worked. And then I think from there, what you've seen, and this is from, what was it, the 8th to 9th of November, is the vaccine. You've seen the vaccine come through, and you've seen the vaccine being rolled out. George talked a little bit around the vaccine rollout in the US there, how it's at a faster pace than I think anyone would have expected. But the reality is people are now concentrating on going back to being normal, going back to some sort of normalization, on the global economy reopening. And, you can see that when you look at stock market performance. I think what probably is a little bit different is maybe when you look underneath the figures. And so you look underneath the big uplift that you've seen in equity markets, that's filtered into the true potential portfolios. And what you've seen there is quite a divergence in style. So for the first part, from the sort of 23rd of March up until we saw the vaccine come through, or maybe just a little bit before, what you saw there was, the kind of what I call the stay-at-home stocks. So, names, things like Netflix, Amazon do phenomenally well because we're staying at home, But then what you've seen from there is you've seen a switch in investor preference. So areas such as energy, the cheaper areas of the market, the catch-up trade, the areas that are more geared into the global economy overall, you've seen them start to do really well. So for me, when we look forward, for me, I'm quite positive. The way that we're positioned within the true potential portfolio proposition is to offer diversification, but we do have a tilt towards the areas that will do well as the global economy reopens, and I see that continuing.
Yeah, Jeff, something Chris said, I just wanted to raise with you about not timing the market. Don't try and sell at the top. But of course, the underlying funds that we have within the portfolios, the managers are paid to make the decisions as to when to buy an investment and when to sell it. When we look at the trades which have been made within our own fund that we manage ourselves in-house, growth aligned and to a certain extent global managed fund, some money's been taken then. We've seen some sector rotation. Profits have been grabbed. In active management, that is vitally important, that you do take profits.
Vitally so. And that, I think, speaks to the heart of the proposition. It's allowing those that are skilled in that process of identifying that opportunity where there is value and where there is, going back to that our previous conversation, opportunity to identify those mispricings and exploit that opportunity that's presented in the market for our clients. But then, as you rightly say, it's about recognizing when that opportunity is maybe no longer as attractive, maybe the valuation's closed, or there's a more attractive opportunity that one can identify. And a good example of that to think about is what has happened within our internal portfolios around US small cap or small cap positions in general, where there was a very significant mispricing and a valuation opportunity, small cap more tied to the economic reopening. It made sense to get exposure to that within the portfolios, rotate a little bit away from some of the larger cap areas. But to give some perspective in that's an asset class that is probably re-rated from some 20 times earnings to somewhere close to 32 times earnings. Now, that is a great recovery that's been baked into that. That opportunity has been captured. It's then about looking for, well, where can I deploy that capital to earn a better opportunity than that one that I've just captured? And that's what all of our managers are seeking to do all of the time. And that's what they are, if you will, they're employed to do. They're wanting to build, and we are building alongside them, a solution for investors to see them through the long term, but capturing where all those mispricing opportunities are along that journey and taking advantage of active management within it. So crucial, and that's what we see within our managers. We're constantly looking at and interacting with them. George has just been speaking to Allianz there today, but to understand where they are are seeking those opportunities, how they're being exploited, and what it's going to add to the underlying portfolio. I think the other thing, sorry, go ahead.
No, go ahead.
I was just going to say, one of the things, I suppose, just reflecting on the past 12 months, it's kind of where we swung from complete pessimism to complete optimism within the space of a number of months. If you just cast our mind back to entering into 2020, it was all about a positive outlook in terms of where we were going, and then we swung to outright pessimism at the depth of the market, as Chris has been said, in the 23rd. And that I suppose is the want of us as individuals. You swing from one to the other, and you kind of forget that there's a need to be optimistic and positive about the longer term evolution and the journey that we're all on in terms of growth that's out there, the innovation that's out there, those things that really are the positive. We maybe don't reflect on some of those enough. You think about the medical advances that have come through in the past 9 months. We've got a vaccine for a disease that we didn't know existed until the beginning of last year. That's not something that society has ever achieved in the past, yet that has been enabled by technology, the evolution of technology, the investment in that, and the real focus that's been brought to it. So we can solve problems. So we kind of need to look to the positive as well about what's happened and what's been learned.
I think that's very true. And, Chris and George and the work that they do every day, they've got to maintain that degree of impartiality, because we've got very talented managers who are working for us and working for our clients. And Chris mentioned three of them, the big global institutions, which are Goldman Sachs, UBS and Allianz. But also we've got other quality managers who have a different investment style. We've got SEI, 7IM, Close Brothers, Columbia Threadneedle, and Schroders working within the portfolios as well. And the point that I made earlier about Chris not having an asset allocation that he has to follow, we don't say that, right, you've got to put X amount of the portfolios with any one of the managers. We take their styles, we take their views, and we blend them together to have the best position going forward, having listened to what everybody has to say. So it's a very flexible investment portfolio that clients can invest in.
Yeah, I think for me, the key for me is maybe what Jeff was saying around opportunity, and maybe what you're saying as well around flexibility. So I think there is always opportunity in multi-asset. We're in some ways, we're very lucky that we work within multi-asset fund management, because there's always opportunity there somewhere. And I think our managers have flexibility around where they choose to invest, what assets they choose to invest in. And for them, it's around what their view is, and then trying to find what they believe is the optimum way to enact that view overall. So for me, I think we're actually in a really privileged position, in the sense that you have the very best thinking from all the managers that we work with, and I genuinely believe the best managers in the world right now, otherwise we wouldn't be working with them. And you can bring all of that together within one portfolio overall. And the key is, if someone says to me, well, do you think maybe like the US equity market, or the FANG's overvalued, something like that? But even if you do believe that, there's so many other areas that they can invest in. There's so many other products that they can invest in. And for me, that's what's so powerful about what we do.
Yeah. And talking, about future positioning, let's look ahead. We've done the review. We've done short, medium, and long term. Jeff mentioned before he's a couple of weeks behind us, who are south of the border, but lockdown is coming gradually to an end. What do you see happening? I mean, vaccinations. I got vaccinated on Sunday. So hopefully I'm a bit safer than I was this time last week. But the signs, isn't there, out there of just things starting to return to the norm? A couple of examples from me. I went out last night out into the garden, and I could hear a couple of neighbours who taken the first opportunity to have 6 people in the back garden, and it sounded like they're having a great time. I wasn't invited, so that's maybe a message that I'm hearing. But also the local airport at Newcastle is announcing new routes. You know, Ryanair have announced 2 or 3 new routes just over the last couple of days to try and get people on holidays, perhaps in 2021, but certainly in 2022. So for the portfolios and the investments in there, what are we looking at, gents?
Well, I think in that there's many ways to think about that, isn't there? And if we think about some of the markets that our managers are talking about, it's about speaking to this theme of rotation. Where are some of those areas that might benefit? And we see that within the stock picking managers, but we also see that within those that are allocating and using index providers to do that. So at one level, it's very stock specific. At another, there's certain regions that benefit from that and a lot more. We think about that in the case of Europe. We think about that in the case of the UK market. There is clearly increasing interest in UK assets. We see that in terms of the performance that's been delivered of the market here in the UK. We see that at a sectoral level in Europe as well. So there are very different opportunity sets that can be exploited to that reopening theme. I think the other thing that we've touched on here is that rotation from growth and value, and we know that value has been out of favour. But if we want to get more technical than that, if we look just the relative value opportunity, the spread that there is between value and growth is very significant. That's presenting opportunity for managers as well. And I think it's very much tied to Chris's point, Mark, that there's opportunities created across the asset spectrum in that theme of economies reopening, be that in bond markets, is that sovereign, is that corporate, is it high yield, is it even in emerging markets, is it in currencies? There's different currency pairs will react differently to we see economic growth coming through and we see inflation expectations changing, but also interest rate expectations changing. Each of those dynamics are at play within the portfolios and are creating opportunities across the asset class spectrum. And that is at the heart of multi-asset investing. That's the real beauty of it, that there are those various different levers that we can pull in terms of the allocation to our managers, but there's also the levers, I should say, that those managers can pull within their strategies and identify. Maybe one sees a better opportunity in currency, they should go ahead and definitely try and exploit that. Maybe somebody sees something in corporate bonds or in high yield bonds. By all means, go ahead and exploit that. It's our task to bring that together into a portfolio view that captures that in the best way possible to deliver a client journey and allow our clients to achieve their goals as a result of that.
I think as an analyst, it's fascinating for me because you're working with managers who all have a slightly different view on the world. They all have different areas of expertise, and we're bringing all of that together. So if we think about, okay, economies opening back up, everybody knew it was going to happen at some stage, but nobody knew the exact date. So you got that really positive reaction on Pfizer Monday, November 9th, when we started to see the light at the end of the tunnel coming through. So if we're looking at, how are our managers positioning towards the reopening theme, you've got some managers who are already there. You've got some managers who've been there for some time. So when you did see that vaccine news come through, it was a real positive boost to those managers. And we had that positioning for those managers. You're seeing on the other side, opportunities coming through on a selective basis. So whether it's individual companies, individual firms, which they're buying. So you've almost got 2 layers there. You've got those who had that view, that belief since before the start, before we knew when those dates were starting to roll out. And those managers who are active in their decisions on a day-to-day basis and still able to pick up the opportunities within the UK as an example, or other developed markets where they're still seeing opportunity in Europe or Japan because they are the more economically sensitive markets relative to, say, the emerging markets who came out of lockdown earlier than the UK did, as an example there.
I think the other thing to put on top of that is one of your comments earlier, Mark, just around how markets have recovered quite a lot from where they got to at sort of that nadir last year. And that is what markets do. They're a discount mechanism. they get too pessimistic in the eye of the storm. They maybe get too optimistic at other times. And it's about using the asset opportunity to navigate a way through that gives a sensible return to the end client. And that's something that, if you think about it, the market is discounting a better economic growth profile. We have to go back a long time in history to see US GDP at 6.5% on an annualized basis. Yes, we could say maybe some of that is transitory as we recover from where we were and getting back to that level. It was the end of 2019, so we missed out a year, if you will. We took or governments effectively removed a year out of the growth profile. So we get economies back there, we get market earnings expectations and the delivery of earnings back to that level and beyond that. And that continues to support the ongoing direction of travel, economies reopening, economic growth feeding through, employment prospects improving, people going out, people consuming services again, releasing some of that pent-up demand that I think we probably all attest to, that there is pent-up demand out there. I think we'd probably all like to go out and have a meal out or something at least like that. So, there is that demand there, and that will feed into economies. It'll feed into markets.
How long do you think it'll be before Donald Trump claims credit for that US growth?
It's been remarkably silent, hasn't it? It's been great on Twitter recently. We haven't had to contend with any sort of presidential tweets in the middle of the night. We just was it last week or the week before, there was the summit between the sort of high-level delegation from China and the US. And you could probably have got by without thinking that happened.
Yeah.
But I think I could probably say with some confidence that if that had been happening at any point in time last year, with Mr. Trump in charge, we would have had a Twitter storm around it and we'd have gyrations in the market as a result of that. Well, thankfully we had none of that. We've probably got enough to contend with, but not having that in the background is certainly beneficial.
Absolutely. And, thinking about everything that's happened in the last 12 months, and even just looking what's happened this week, in the 3 days of this week, the markets, world events move exceptionally quickly. The markets move as quickly. So it's a full time, and it's a very, very important job that we do and our managers do. And just, something that was said earlier about the managers that we have. They're spread right across the world. They've got resources in every major financial capital, in every market that we need to have coverage. People on the ground to see what's happening, not just reading reports, but seeing it, witnessing it for themselves. And that type of insight is vital when we come into the multi-asset portfolios. Gentlemen, we're coming up to the hour now. I just want to ask you a little bit about this elongated weekend that we're having. George mentioned Pfizer Monday, which I won't let you forget, George. That one's going against you for a long, long time. But we've got Good Friday and Easter Monday coming up as well. Chris, I'll start with you. What plans do you have for the Easter weekend?
What plans do I have for Easter weekend? I can get pints of lager delivered to the house, which is something that is genuinely one of the most exciting things that's happened to me in the last 3 months. So I plan to get some lager delivered on Saturday. One of my mates who lives nearby, I think he's going to come and sit in the garden, depending obviously on what the weather's like. But at this point, even if it's pouring down, I don't mind. I'll just probably put a coat on or something like that. Other than that, not too much. Bit of exercise, bit of healthy eating maybe as well.
I was going to ask you about your favourite Easter egg as well, Chris. So you can start on this one. What is your favourite Easter egg?
So my favourite Easter, I don't know if this is an Easter egg. My favourite Easter product is, I don't know if I said the way, Cadbury's mini eggs.
Right.
And that's been something that I've liked since I was kind of young lad, basically. Yeah. But yeah, as long as I don't like dark chocolate, so nice kind of traditional milk chocolate, and it doesn't need to be anything fancy. Cadbury's or something like that's absolutely fine with me.
Okay, George, favorite Easter egg?
Favorite Easter egg? I'm a classic dairy milk. Dairy milk's my favourite one. So if I get a dairy milk one, which I haven't actually had an Easter egg for a long time now, but if I get one, then they'll be in the good books.
Jeff,
I've tried them all, Mark. I have tried them all, I think now.
Jeff, your Easter egg buying might be a little bit different to everybody else because you've got two lads who no doubt will be getting hundreds and hundreds of eggs. Yeah. Which ones do you steal from them first?
I think if there's a contrast to Chris, if there's a dark chocolate one, one of my sons will eat that, one of them won't. But I'd like to help them with that. Usually, I'm quite partial to dark chocolate, so that, or the traditional cream egg. Hard to beat those. So we'll have a few Easter eggs. I think we're planning for an Easter egg hunt in the garden, so we'll hide a few eggs for the boys with a few clues and have a bit of fun on Easter Sunday trying to find those.
That'll be good. And Chris, I know that in the past the podcasts we've touched on your morning exercise regime. Now you've probably just shattered that by saying that you like mini eggs and you're having pints of beer delivered. But I think it's only fair that we let everybody know that you've made what I actually think is exceptional progress in your exercise regime, and it's resulted in you losing, I said earlier before we start recording, 3 stone in weight, and you are very quick to say, well, actually it's more than that, it's 3 stone and 1 pound. But
that 1 pound means everything.
Absolutely, Chris. It just shows though you've stuck at it. You've got up early. You've been in the park with your exercise regime. You've been chased 1 or 2 times. You've been laughed at 1 or 2 times, but you've won. So congratulations and well done, Chris.
Yeah, no, thank you. It's being in the park first thing in the morning when it's pitch black, including one day when it snowed, which was is not something that I particularly recommend. But and also another day when I did it, which would have been, I did one of them in the evening time. So normally I train in the morning. I did it in the evening time when there were loads of groups of young lads who just seemed to find it really, really funny, all the exercises that I was doing. But yeah, it's I've stuck to it so far. So yeah, long may it continue. And I think there's a bit further to go.
Well done.
Excellent.
Well done.
Well, everybody, that's Chris's health update done for this week. We're at the end of March now. We're entering into April. It's an exciting month for True Potential. We mentioned looking ahead in the portfolios. We continue to do that. That's the essence of what we look at when we're positioning the funds and the underlying investments for you. April will see also us starting to bring staff back into the office. Now, we've functioned as a business exceptionally well during the lockdown months, and in the Northeast, where most of us are living, we've been in lockdown since the 16th of September. Sorry, so it's part of the everyday life now. But we are looking forward to welcoming staff back into head office starting April and more long term in May. And for this evening, I just want to say thank you, or this morning, depending when you're watching it. Thanks for the time that you've given us. Gentlemen, thank you for your insights over the last hour, and have a good weekend, everybody.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.